the case that we're talking about, there was actually almost another layer under that triangle where we called that the age pension. And so we're really trying to target something that looks like minimum quality of life and the goal is 35 to 50, thereabouts. We assume that the age pension is going to give us 25 of that. And then the second thing we did, which some of the other tables picked up, was, I can't remember which one, but we had a term where we said the top of the pyramid is called no tiers. And we're going to allocate approximately half of a year's income to that no tiers, and that's something that's easily, it's a liquidity event, something you didn't see, an emergency. It's not necessarily the $5 grand for holiday, but it's just that providing a little bit of wiggle room with regards to something that you don't foresee. The balance of the capital, then, we had a robust discussion around why it's a jagged line, is because this is where you need your wiggle room. We wanted to bedrock an amount of income, whether it be in term deposits, whether it be in annuities, whether it be in anything, but it needed to be fairly consistent, such that we were trying to provide, somewhere between that 5 and 10 that we required to meet the minimum standard, and roughly in today's terms with annuities or term deposits, that was a number that might look somewhere between, 100 to 180 thereabouts. The balance then was when we started to have a robust discussion about asset allocation. We included cash and we included the bedrock as part of the defensive nature of the portfolio. The balance of the portfolio, then we had a very good discussion about rigour, where typically we were a little bit more aggressive, and that had to produce, at any given time, the difference between 35 and 50. But this discussion happened every year. And inbuilt into that 35 and 50, we asked questions. Does that include your health insurance? Does it include our fee? Is it things that you haven't thought about? And at the end of the day, though, every 12 months, this visual was drawn again. The portfolio was assessed on whether it had been successful or not by reducing the gap. The notes, any excess income was either directed into this account here, which has sometimes been depleted, or back into here, or reinvested. So we used that visual almost before we started talking about asset allocation every time. We drew it a number of times throughout the course of the client's life. And often the client would come back with the first bit of paper that we drew them with this, with their own numbers on it. And that was a really healthy way to start a review discussion, even long before we talked about asset allocation and returns. So, common sense, but not necessarily common practice.
Good, mate. All right, thank you.